Welcome to Outlook Money. You're watching Beat Volatility with Mutual Funds, an investor education initiative by Aditya Birla Sun Life Mutual Fund. All of us have heard the line mutual funds sahi hai. But do we actually believe it? How do SIPs work? Why do we drop out of SIPs out of fear? Today, to answer all those queries, we are joined by Lalit Sharma, Zonal Head of Investor Education at Aditya Birla Sun Life Mutual Fund. Welcome, Lalit, to the show.
Thank you, Ankita.
Okay, let me start at the very beginning. If you have to convince a 23-year-old Gen Z on to invest into an SIP who would rather buy a sneaker or an iPhone, what would be your selling point to them?
Yeah, of course. See, for a Gen Z, or for that matter, anybody for that matter, to create wealth, the two things required. One is large sum of money to invest. Second is time. So a Gen Z may not be having large sum of money to begin with, but one thing they have in abundance is time. So to convince any Gen Z, I would definitely start make them realize that you have time on your side. Even if you start small with SIP, because that's a powerful tool. Even if you start small, take it for a long time, it can definitely create long-term wealth for you. So Gen Z need to be, another thing, they need to be sold something modern, no traditional stuff. So they need to told that it is new age stuff. So SIP is definitely old, but it has taken a lot of avatars. So a lot of innovation which has happened in SIP. Gen Z needs to understand that it is for them. It will definitely create wealth for them in long term. So these are things I think I will try to convince a Gen Z on.
Do you have a success story? Somebody you convinced and who was actually happy getting a lot of money at the end of their term?
Yeah, so see, charity began at home. I had my niece. She was doing her master's last 2 years. She was getting around 18,000 stipend. So I tried to convince her that why can't you spare 10,000 for SIP. It was very difficult, but I tried to convince her, and somehow was successful convincing her that 8,000 for us, for a kid in campus life is enough, I think, for taking care of monthly expenses, especially nowadays these Gen Z guys. They have a strong financial backup because of their parental support, so they don't have to take care of a lot of stuff. So major purchases they can take care from their parent side. So somehow I could convince her that why don't you spare 10,000 for the SIP, and with a lot of resistance, she agreed, and then started the journey of systematic transfers, and she realized that everything happens on digital, everything is available from click of a button, and there are a lot of innovation which happens, and transparency. She could see what is happening to her money every day. So somehow sometimes it created a lot of anxieties, and markets also were little volatile, and she could see valuation going down, my money is going down, where have you put my money into. So those conversation happened, but in last 2 years what she could learn is she has actually seen this cycles. She learned that when money goes down in value, it comes up as well. So that was another stuff she could learn, and there was times when I tried to convince her that okay, markets are down, don't worry, you are actually taking advantage of cost averaging, which in theory is different. When you realize it after 2 years, you realized, oh, because of this I had these many units. So the few things which actually created a lot of anxieties, which actually created lots of doubts in mind, but at the end of day I also try to teach her that you need to understand real return concept, because yes, inflation is there, and whatever returns you generate, you just need to keep in mind that whether your money is earning real return, that is inflation adjusted return. So there are few very simple things. This SIP thing, you can she started small, and it actually she also seen a lot of variations happening, lot of market cycles happening, because market has been volatile for the last 2-3 years. So I think that was blessing in disguise. It was very small amount, and she could learn a lot. And last year only she got placed through her campus support, and obviously the income has grown up. Now she's shifted to Mumbai, and a lot of rental expenses, a lot of expenses on her shoulder. But she had the courage of increasing the SIP value, because now she understands that this is something I need to do with my money. So I think that's a success story which I could sell, which I could start from home, and I believe that I can carry this story to many more Gen Zs. I hope so.
Hopefully, she's sending you lots of gifts from that interest.
It has not yet started. It is only other way around. But yes.
Okay, so there's a lot of talk of flexibility when it comes to SIPs, that you can start and stop at any time. But recently, earlier this year, the stoppage ratio actually jumped, due to market volatility. So my own cousin, stopped their SIP in 2020 and now regretting it. So what really works?
So it is, common behavior, or natural behavior of any human side. 2020 was an exception year, and if you see, your valuation going down by close to 40%. So holding your breath, holding your investment commitment is really tough. And your cousin may not be the only one. There were so many people who did that, but there were other side of people also who continued, and they actually benefited over a period of time. So yes, sometimes flexibility is a problem, because it gives you a lot of options. You can, and a lot of transparency. You see what is happening, and it's all just a click of a button. You can stop it, you can redeem it, and you can shift to other fund type. So all these things happen because it is being provided to give comfort. But at the same time, people do fall in for these market cycles. I would say that yes, continuous guidance is required, and for especially Gen Z, even if they want to do a mistake, let them do it, because it will be not that costly mistake in the beginning of their investment journey. Let them learn it.
How do you calm their anxiety?
Uh, Before that, I need to calm myself first, because anxiety, hits everyone. So I also go through that. I am also an investor. So first of all, I need to, apply principles what I learned over a period of time, and then I try to, convince them that, if it has gone down, it will come up. So that's the only way. I mean, you need to keep on doing it.
Okay, so there's a concept of rupee cost averaging, and let me ask you very bluntly, which means that when the markets go down, it's actually a good thing for SIPs. Do you agree?
Absolutely. So the cost averaging and the volatility, these two, been kept in mind while designing the SIP concept. So what happens that whenever markets are low, that means the price per unit goes down. So with the same amount of investment, you end up buying more units. So this is where you accumulate more units. So it is kind of a blessing in disguise. So anybody who's enrolling for SIP for a longer period, say 5 years, 10 years, 15 years, 20 years for that matter, they need to be happy that within there should be some chunks of time when markets are low, because you accumulate more units, that is going to impact your value at the end. Okay, because we always say that take advantage of power of compounding. Where will that come from? Of course, there are returns and growth, everything is there, but the valuation also comes with the number of units into market price. So number of units has to multiply. So it multiplies with the same amount of investment, and you're buying more. So that is where we always say that take advantage of SIP, because markets are like that only. Market will go up and down. This is only tool which will let you buy at lows, buy at highs. So it is win-win for all. So take maximum advantage of rupee cost averaging, and that helps you ride the volatility. So yes, volatility is good for all SIP investors.
So Lalit, when was the last time you took advantage of something like this? And if you are comfortable sharing the profits probably, or the interest you would have made in margins?
Yeah, of course, and not far off. I mean, COVID time, because markets were really down, And many of my friends actually shifted their 5 year 6 year SIP corpuses into liquid funds, because everyone we were fearful, and they were also 30-40% whatever market went down that time, it was not enough. People were thinking that it will go down further, but somehow I kept it going. And because I learned my lesson from my past mistakes, as I mentioned. So if you learn from your past mistakes, you know that it will come back. The timeline for coming back maybe it may vary from past to present. So but it will come back, because life goes on, market goes on. As long as you don't need money, you don't have to be fearful. And of course you need to trust the market first. You need to trust where you've been investing. Until unless you have any doubts, you will keep on going. So I did that during COVID 2020, and it paid off well, because I did something we call budgeting, where we keep emergency fund for say 12 months or so. Your household expense you keep aside, so that you don't have to touch your long term money. So I followed that principle, because I learned it through my journey, that don't mix the two. And your goal and aligned SIPs or aligned investment should be followed with the discipline. I did that, and I think I reaped those benefits. And everybody understands, everybody knows that after 2020 where markets went. So I am the beneficiary.
I
One
think
of the
that's
beneficiaries. Yes.
yeah, that's a very good example. Systematic investment planning, we use it as a blanket term. Is there more to it? And what are the different kinds of SIPs and how do they work?
See, one is of course the regular SIP, which is on a monthly mode. People, give instructions to their banks and select their respective schemes. So money gets deducted from your savings account. You know, it gets invested every month. So that's a regular SIP. Everybody understands. Everybody knows. But there are different frequencies to it. Now it is started on a daily basis also. There are daily SIPs, there are weekly SIPs, and fortnight basis as well. So many AMCs provide that. People have that choice. Another feature of SIP is step up or top up SIP, because I would say that's a pudding on the cake. Because when you use step up, I advise especially Gen Zs or anybody for that matter, if you have plans to invest in SIP for 5, 10 years, 15 years, 20 years, please use step up or top up SIP feature, because that actually helps you realize your financial goals. I'll give you an example. See, nowadays every one, or especially Gen Z, have their goal of creating first 1 crore, because it is saying that first 1 crore is always difficult to make, and SIP is a tool which helps you create that 1 crore. So just an example, if somebody plans to invest say 10,000 for 20 years every month, 10 20,000, so you end up investing 24 lakh rupees in 20 months, 20 years, to 40 months actually, assuming that returns are 12%. So you get to create 1 crore of portfolio, 1 crore of value in 20 years time. But if you tweak it little and be a little disciplined and add your SIP amount or top it up by 10% every year, say 10,000, so 1,000 next year, and then so on, so on. You can actually prepone your 1 crore goal, and you can achieve it by 12th year. That's the kind of power step up actually provides your SIP. Or if you continue for 20 years, your corpus can be equal to 2 crores. So that is the power of step up and top up SIP. Not many people use it, but my advice is that please use it, because normally what we do that we put a lot of efforts in booking SIPs, and we did it and then we forget it. But just do a little, put a little bit of effort and use this top up feature. Add this 10%, 5%, whatever is your convenient or you are comfortable with, then see the magic, and then wait for the magic to happen, because few things take time to create. So 10, 15 years, 20 years, you can actually prepone your goals. You will achieve them earlier. and if you continue with the longer time, you will actually create a lot of wealth. So this top up and step up SIP is a good feature which I would recommend people to use. Then there are features like pause. So sometimes there are difficulties, there are jobs going and monthly income stopping. So people have problems in getting their bank accounts debited every month. So there are features, many AMCs provide this pause feature, so you can pause your SIPs for some time. So that feature is also there. And there are trigger or value SIP, we call it. In trigger SIP, what we say that in rupee cost averaging, when markets are low, you end up buying more units. When markets are up, you end up buying low units. By using trigger or value SIP, what the idea is that whenever markets are up, you buy less because you put less money, because it is already pricey. When markets are low, you increase your amount so that you buy more. So it is basically to add more features or more advantage of market conditions. So you program it like that market goes down say 10%, you increase your contribution of SIP. Market goes up by 10%, you decrease your SIP for some percentage, so that you don't end up buying more costly units. So whenever units are cheap, buy more. It's costly, buy less. So it is a kind of a more maneuveration on actual feature which is already there, because it actually does that averaging. But value and trigger SIP also helps in doing that. And there are a perpetual SIP because they don't come up with end date. So I recommend everyone to use perpetual feature, so that you don't forget to renew it, because when you keep 3 years, 5 years kind of a tenure, and then it gets stopped, it goes away from your mind, you don't take action, and SIP investment stops. And then you realize after 10 years, oh, I should have continued it. So avoid these little bit of mistakes, and these are kind of SIPs which I could recall.
I found the trigger SIP really interesting. So recently in the markets with all the volatility, if there is somebody who doesn't track markets that often, somebody like me, I probably wouldn't, see the markets for a week or 10 days, and a lot changes, right? So how do I use this feature then in my SIP and take the best advantage if I'm not somebody who keeps tracking the markets like that?
So basically, this feature is made for people like you who don't track or who cannot, ascertain that whether right action should be taken at this level or not. So it is better to keep it to the experts. So every AMC or the whoever is creating this solution, they have these parameters. So the system is based on some set rules. So whenever the system recognizes that market has gone up to this level or market is this level, so there are predefined amount limits which gets triggered. So the moment it matches the condition, it will trigger. So I mean, you can just give the directions or give the instructions to your fund. They will manage it on your behalf. You just need to give them one-time instructions, and then they will take care of it. The system actually takes care of it because it is on automation basis. Nobody is taking individual decisions then and there. So it is basically market driven, rule based investing, but in a systematic manner.
I think I'm going to try it for sure. So when I started earning myself, my mother and everybody in the family, everybody senior, everybody was telling you, put at least 500 rupees in the SIP, put this much from your salary, start investing today. And that is what we hear even today, like you were giving example of your niece also, whosoever. But what happens is with different income levels, and somebody is earning 2 lakhs, somebody is earning 50,000. How does one person actually decide the amount of money they should put in an SIP?
So one thing is clear, that it is not one size fit all kind of a strategy. And another thing is also true about this market, is a person who is earning 50,000 today versus a person who is earning 2 lakhs today. The person earning less can be richer in 20 years time than the person who is earning 2 lakh rupees. So market has that power. So it's all about how you behave, how disciplined are you, how consistent are you with your investment planning, how good are you with your budgeting, and how good are you in planning your spends, because impulse spending or unplanned spending also hampers your budgets, and of course it hampers your investing plans as well. So if a person with 50,000, he knows, he understands his limits, and he understands he needs to spend in within this limit, and he spares funds for investing and is committed for a long term investing, I think that person can create a lot of wealth, and it will be happier than the person who earns more today but doesn't invest, doesn't plan, and impulse spending, of course, will not be will not remain rich okay, with this behavior. Coming to the right amount of SIP, so there are you need to first identify why what you need money for. So you need to identify what goal you are actually planning to achieve. Say there could be any goal. Say there could be higher study goal. There could be dream house. There could be dream car. There could be dream destination. And of course, most important is kids education and retirement planning. So there are multiple goals which has a monetary value. They have emotional value also, but there is a monetary value attached to each and every goal. So for that monetary value, so one figure you come that this is the kind of money value I need when I reach this stage of my life. Okay, when you're getting married, when you're becoming parent, when then you plan for your kids education. So there are multiple life stages, and every life stage has a monetary value attached to it. So once you know the life stage when it's going to come, so that means time horizon. So you get the time that after so many years, or after 1 year or 5 year or 10 year or maybe 30 year, 40 years, I'll achieve this life stage. So since I achieve this life stage at that point of time, I need this much money. Okay, so you need to have that kind of planning. And once you arrive that amount, then there are tools which will tell you that how much money you need to commit every month, okay, in SIP mode from today onwards. So you can easily plan, and of course your plans or your goals has to be smart. We call it smart goal. Smart means it has to be specific, okay, it has to be measurable, it has to be attainable, it has to be realistic, it has to be time bound. I cannot have a goal which I may not be able to achieve. I cannot have goals of something unrealistic, because I don't have that kind of income source, I don't have that kind of plans. So whatever is in my reach today, and I think that I can afford to commit this for a long time, I should plan that kind of a goal. That is why we call that it should be measurable, it should be realistic and time bound. So I think everybody has their own lifestyle, everybody has their own money needs, and basis their financial goals, there are tools available which will give you exactly the amount you should start to achieve that goal. So the idea is each financial goal should have one SIP to support it. Once you are committed to that goal and that SIP, don't touch it till the time that stage comes to realize it. That is very simple to do.
I think that's just letting that money be is kind of difficult for people.
Yes, because we think that these financial goals are very important in anybody's life, because we earn to achieve these goals. So for our side, we coined this particular term like सबसे important plan. So we SIP is defined as सबसे important plan, because systematic investment plan is we think that there is less emotional value, but सबसे important plan actually relate to that importance, that you're earning money for what? It has to achieve some goals in life, right? So please attach that emotional value, and then I think that increases the commitment value also.
I think that's a very good thing. We're going to use this line, increase the emotional value. So basically with SIP, long term is the buzzword which is like attached. But what exactly is that long term? Is it 5 years, 10 years, 20 years? What's your definition of that long term?
Why this term long term comes into picture is that market is full of assumptions, speculations, and noise, and even if you are certain about few things, you cannot, say for sure. And when something doesn't realize in that particular time frame, people gets, uh, anxious about that, whether, I've done a right decision or not. So long term actually takes care of a lot of noise. Okay, even markets are doing well, sometimes you don't see the returns coming, because there are a lot of factors which comes into picture, and that is out of human control. So you cannot plan for that. But one thing is clear, that if something is in a right direction, it will definitely happen. If some company or a country is doing well, in if you talk about the country, if everything is plays and everything is doing good, we should have the confidence that we will become, say, a developed nation, say by 2047, as the commitment we have taken as a country. So if, as long as I'm confident that we are going to achieve it, I should have that confidence in the financial market also. So one is that. Second, long term is defined in such a way that, do I have adequate window of putting that kind of money? Because I cannot have a goal, say in 5 years I should have 10 crores or a 1 crore. That is not possible until unless I do something, out of the way. So if I have to be realistic, I need to give adequate time with proportion to my incomes. Whatever income I get, I need to spare money for that investment right after my spends. So long term definition is definitely, bases the goal, because if somebody is 30 years, that person knows that by 30 years is the term for his retirement. Okay, so the 30 years becomes long term. If someone is, say, 50 years, for that person 10 year would be long term, because he has to plan something, because after 60 years no one is going to fund him, he has to fund himself. So that definition changes with the person's life stage. Yes, 5-10 years, when we come to the practicality of what is the practicality. So if we see the past performances or past returns, we have seen that 5 year is basically a term where the chances of getting negative experience from SIP is negligible. In all the phases, the 5 year term, if somebody runs their SIP on a regular basis, the negative experience chances are very less. So that is why normally we say that 5 year plus should be, because normally a market completes cycle within 5 years. So even if it doesn't matter which stage you are entering, even if it is top of the bull run and then followed by a bear, it will still come back in 5 years, because that is how we have seen that the kind of cycle age is. So 5 years plus, I guess, should be anybody's time for a horizon, especially for equity asset class, because equity takes time. Sometimes it comes up early, sometimes it takes time for recovery. But 5 years, I think 5 years plus is the practicality in terms of long term. But I will still recommend that you align your long term or any term with your goal. So whenever that goal or that life stage is coming, that should be aligned. Okay, so it should not be that 5 years completed, now let's redeem. That's not going to help. So please wait for your life stage and then start thinking of realizing money.
So what is actually your longest running investment? And if you don't mind sharing, what was the goal?
Yeah, so the first goal was to pay off my home loan. So I think I ran my SIP for 10 years. That was in 10 years that SIP was able to help me with my loan payment. But the longest SIP is 15 years, which actually I benefited.
That's very nice. So, just curious to know if there's somebody who wants like money in like 2 years, like my aunt who's in her 50s and wants to pay for the college fund of my niece. Would SIP really make sense for them, or actually it's just disaster waiting to happen?
Of course not, because there's a myth that mutual fund only talks about or only invests in equity. It's not all about equity. So there are other kinds of funds, and especially people who have a goal which is less than 5 year, say 1 year, 2 year, 3 year. So there are debt kind of a funds where we call it fixed income schemes, and goals like within 2 years definitely should be utilized. SIP mode should be utilized in debt funds also, because debt funds also give very good um, I would say better returns. I would not say that it will exceed, but it is better returns, because uh, market provides you that kind of opportunity, because people can invest in government bonds, RBI bonds, state bonds, and banking papers, and the bigger corporate bonds. So the lot of options are available through debt funds also. It's not just equity. So people need to understand that mutual fund is not just about equity. For long term, yes, we definitely advise for going for equity. For short term, there are debt funds. Go for there, put your SIP amount, and then after 2 years you can take it and use it for your goal. So because there will be very less volatility, because that's why debt funds are better in terms of volatility. Debt funds are better in giving you stable returns, and I think your aunt should be using that route.
Okay. So if SIPs are generally, you start an SIP when you don't have lump sum money. Imagine if you have, like I have 5 lakh rupees today. What should I still put it into an SIP or lump sum? What would you do?
Yeah, that's really interesting, and many people ask this question. So first of all, we need to be very mindful of the fact that SIP is for a case where lump sum is not available. There is this comparison is not a comparison of equals. It's not apple to apple comparison. Lump sum has its own advantages, disadvantages. SIP has its own advantages, disadvantages. So I'll take your example of 5 lakh. So suppose you have 5 lakh today, and you okay, tell me, when do you need that 5 lakh back? 5 years time? Okay, so let's take you want to invest 5 lakh for 5 years. So there are two ways. One is lump sum, another one is SIP. Let's take hypothetical example. You put 5 lakh for 5 years, and we are assuming that you will generate 12% return. So your outcome would be around 8.8 lakh, okay, with 12% return. Now let's divide it into 60 equal SIP amounts, that is 8,333 to be precise. So this 8,333 you will invest for 60 months, because that's what you are committing. So at 12% your returns would be 6.81 lakhs. So you can see the difference. See what happens, the base has a value. So when your base is starting with 5 lakh versus 8,000, definitely your return is starting from day one. Okay, that number one. Another thing is that if the only thing which I could suggest you is that if markets are volatile, okay, and there is a risk that if I put 5 lakh in one go, and markets starts going down from here, okay, and since 7-8 months it is down. So first of all, market has to recover. So it will take another 2-3 months in recovering. So 7-8 months you hardly earn anything. Okay, so that is the risk with lump sum. But since you said 5 years, so I will not suggest. So in case what maximum we do in the volatile markets, that we stagger the investments in say 5-6 months, not beyond that. Okay, so 5-6-7-8 months the lump sum amount should be staggered or then applied in the market. If you compare it with SIP, so what happens in say two cases? Let's say somebody has a plan of 10,000 SIP, another person has 1,20,000 rupees. So 1,20,000 one lump sum and 10,000 SIP. So from there on, the day one markets is volatile. Okay, so suppose the in the beginning the NAV was 100 rupees. So 1,20,000 guy got 1,200 units, and this guy got 100 units with 10,000. And then next 1, 2 months, 3 months, the prices were volatile. Sometimes it was 95, sometimes it was 90, sometimes it was 85 kind of. So by the end of 12th month, it could be a possibility that one side the number of units fixed 1200, and this guy who started SIP, the number of units may be 1300 because of this low pricing, and the market goes, say NAV goes up to 110. So 1200 into 110 and 1300 into 112. So by putting 10,000, the guy using SIP route made more money rather than lump sum guy. But that is not the right comparison. Market could have gone otherwise also. Okay, the day investment started, market could have gone into one direction. So that 1200 could have been into 120, and since prices are going up every month, 100, 102, 105, 110. So the guy, second guy is ending up buying less units. So there could be possibility that he is only buying 1000 units by the end of year because market is going up. So there are pros and cons both sides. But at the same time, when we talk about 5 years, so 5 years, what happens that average means also comes up. Over a period of time, the average thing also comes up. So with average thing where benchmarking happens, the prices volatile still fluctuate, but above that benchmarking. So that benchmarking may be above that starting price. Okay, so there I would say that lump sum sometimes it is not comparable to SIP, because SIP is staggered investment, it is happening over a period of time. Lump sum you're putting today, so there could be a case where opportunity cost is also there, because lump sum would have given you from day one. So in 5, 6, 7 years, so it is not comparable. Lump sum has its own advantages, and SIP has its own advantages. So SIP is basically for those who don't have lump sum and who wants to start small.
So if there was somebody having the same thing post-COVID, let's say 2020, had this 5 lakh, how much, what route should they have taken to have that kind of money today?
So if the horizon is longer, say 5 years or more, then we would have suggested that because markets were down, so it was not a rocket science put everything in lump sum, because it was a very corrected market. So that was easy decision.
Okay. So today, today's generation, or even a generation before that, today everything is on apps. You are on your phones all day. You actually track your NAVs like 10 times a day. It's like scrolling Instagram or Facebook. Is that a way of tracking right? Or what kind of discipline should one follow? Or just let the SIP be? Or is it necessary to keep tracking it like that?
So see, the moment you get into something like market linked, and there's a lot of noise, a lot of people giving you that kind of information, you're getting it from various sources, and see, you don't look at your fixed deposit where it has gone, you don't look at your EPF amounts where it has gone, you just come to know only about your market linked investments, especially in mutual funds, who announces NAV daily, who discloses portfolio every day, and there are a lot of people who are analyzing mutual fund and comparing it. So you are bound to get a lot of information, and then when you see that your scheme is not among top, or your scheme is not doing well, so you get to feel that whether you are doing it right by not doing something. So sometimes not doing something is also a good thing, but sometimes not doing anything is also not a good thing. So yes, there should be regular reviews of your investment, because it is your money. So I recommend that 1 year annual review along with your advisor, if you have one, do it by sitting together. If everything is fine, keep it going. And not every market incidents call for an action. So there is a myth that something has happened, we have to do something. No, you don't have to do anything, because that market incidence was not your doing. Okay, so it will correct itself. So yes, be aware of it, but doesn't mean that if you are aware of something, then you have to do something. So being aware, that's fine, and review it until unless something fundamentally wrong, something really drastically wrong, you don't have to do anything. Just let it go. We call it that fill it, shut it, forget it. So SIP is that mode.
Basically, letting go of the
Yes.
FOMO, the fear of missing out all the time.
Absolutely.
Just calm down those
If
feelings.
you want to feel FOMO, feel about that you're not doing SIP.
Yeah.
Feel FOMO about SIP.
Yeah, right. Okay, so what is the nastiest SIP mistake that you have seen, and also a smartest fix that you probably have seen in this?
So, as I can give you my example. I had to, I was doing, home transaction, and I had my, SIPs running for last 5 years. Um, I couldn't, think of anything because SIPs. See, there is a sometimes your advantage becomes your disadvantage. So since mutual funds are open ended and withdrawing from mutual fund is very easy rather than from your EPF or from your PPF accounts, or for that matter fixed deposits. Uh, Withdrawing money from mutual fund is always easy. So that sometimes is drawback as well, I would say. So what I did, I redeemed all my SIPs running for the first 5 years and paid off my down payment for my home. So, today I realize that if those SIPs would have been running till today, it would have created a lot of value for me because I do this day in, day out. So, I realized that that was a mistake I did because I missed out on a lot of opportunities because of those SIPs. They would have created a lot of wealth for me. Although those were small ones, but even 5 years they could help me with down payment. In 20 years' time, maybe it could have helped me, create a home loan kind of a corpus. So I think that was the big mistake I did. I didn't realize it that time because I could only see that home coming. So I was buying my home, buying my house. So I think I valued, house more than SIP. That time I was not aware of power of SIP. And smartest thing I did was that since then when I realized that I did a mistake, I booked. I started again, and now I'm continuing because now I segregated my long term thing from my short term thing. So no one is going to touch the long term commitment with SIPs. Only short term requirements are taken care by the short term allotment of funds. So that's the only way.
Have you ever met an investor who's going through like a really bad time and you've given like a smart fix to, save that family's portfolio?
So there are plenty, uh, but the worst case came in during COVID time because it was an exception time, and many people were clueless what to do because people didn't have confidence of living longer. They didn't have the confidence that they will survive this pandemic. uh, that time from the organization side also we did a lot of sessions, motivational sessions for the investors like COVID to COVID, because by that time we launched that COVID vaccine. So there are a lot of stuff which we tried doing because people need to have that hope of living first, right? They need to survive first to create wealth before. So uh, yes, few friends of mine, and they were seeking my advice even pre-COVID era, and uh, I tried stopping many of them. So few of them listened to me, few of them didn't. So who listened, they benefited, and even today they thank me. So I think yes, a little bit of helping people due to whatever we have learned.
Uh, okay, you've been teaching this for a very long time and you keep meeting people all the time, What are the 5 golden rules that you would tell everybody to follow when investing in SIP?
Yeah, that's really interesting. So, so they're not my rules I follow because I heard it from somewhere. So, I advise same rules to people. Uh, One, of course, what Warren Buffett has said that you need to tweak your money habits. So, as a natural human being, we earn money, and first natural reaction is to spend. So what he is advised that once you earn it, so you need to spare your savings first and then spend. So I would advise that please earn and then keep aside your savings amount, whatever 15, 20, 30%, more the merrier. you keep aside, and whatever is left, please spend it. First advice. Second advice, that you need to make sure that you work hard, to earn money. Please ensure your money also works for you. So there are ways, and SIP is the best mode of keeping your money to work every month and for years to come. So please put your money to work. And third advice, that you need to be always mindful of creating multiple income streams. Amount doesn't matter. Even small amounts, you start small. Everybody starts small. So you should not depend on one single, especially salaried people. They are dependent on their, salary income. So please start thinking of creating multiple sources of income, and investment is the best strategy, because that generates income for you over a period of time. Even you start small. So be mindful of that. And fourth is take advantage of this power of compounding, because we all know about power of compounding, but we don't utilize it. We don't use this power to create wealth. So you just need discipline and consistency. SIP provides you both. Everything is automated. You just need to commit yourself. So please take advantage of power of compounding. And magic doesn't show in first 5 years, 10 years, 15 years. Everything starts happening 20 years and beyond. And when it starts happening, then you don't even believe it. So please wait for the magic to happen. It will definitely happen. And fifth rule is, which most, financial people, follow, is don't mix your long-term, money with your short-term money. So if you have a goal which is 15 years beyond, of 20 years or 30 years down the line, whatever amount you commit to that particular goal, don't touch it, whatever comes, whatever, be the situation. Please, as plan for those situations which you anticipate can derail your budgeting. Keep 6 months to 12 months emergency fund, so that you should not take these irrational decisions. Plan for high purchase, or you're traveling outside, traveling abroad, or whatever is maybe your requirements or goals. Please plan for it, and then keep aside money for that goal. Don't touch your long-term committed money, which is there to achieve bigger life goals, in future. Because that's the biggest mistake people do. And a little bit of market here and there, and they keep on chasing returns, and keep on doing this this scheme to that scheme. Doesn't help. So that's the only advice I would like to give.
Okay, so discipline, commitment, patience, you need everything. So to wrap up this episode, the last thing I would like to ask you is there a one line that you tell probably all the investors that you meet, or all the people that you train and teach, one line that you also live by?
Save more, invest more. That's the only way to create wealth.
I think that the whole discussion was extremely insightful. Thank you so much for joining us.
You're most welcome. Thank you.
And that's our episode on beat volatility with MFs. So with SIPs, it's not the timing in the market, it's the time that you spend in the markets. Keep watching this space for our next episode. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.